Hi, my name is Sandy Lenner, and I'm a CPA and a Certified QuickBooks Pro Advisor. Before I begin, if you're looking for an introduction to the proof of financial ability to operate and you're not that familiar with the form, take a look at my introductory video, and you're going to learn a lot about this form. It's just 4.5 minutes long. In this video, we will assume you have a basic understanding of the proof of financial ability to operate, and we're going to discuss the most popular question that is asked by applicants seeking a healthcare license when filling out the proof of financial ability to operate. And you might think, what are these questions? Is it how much does it cost, or how long does it take, or is it something else? Well, it's something else. But more importantly, you will get the answer to this question, and you will learn how to use that valuable information when completing your proof of financial ability to operate. Questions, which is really one, is how much do I need to show AHCA, or how much does it take to be approved by AHCA? Well, what is the number that AHCA will accept? It's all the same question. In fact, one applicant told me that his friend was recently approved by AHCA with $100,000, including in the filing, and he was curious if that was the magic number to get approved. Is that silly or not? That reminds me of a similar question. What is the number that someone needs to retire, or what will the interest rate be? Well, there's no simple answer to either of those questions. In fact, hundreds of books have been written on when do I retire and how much money do I need to retire. But in this case, I'm going to help you understand how this number is computed in just a few moments. There is no magical number, as I mentioned. My standard response is that, quite the contrary, the number is mathematically calculated exactly on the form in Schedule 1, which is derived from other schedules. So you need to complete basically all of the schedules before you can come to that number. And that number is really the working capital number, the contingency funding, and a purchase price. The purchase price is only applicable if you're buying a healthcare facility, but most applicants are seeking an initial license. This calculation is just one of the many criteria that helps AHCA determine if you have the proof of financial ability to operate. There's three components to the calculation. One is working capital, two is contingency funding, and three is purchase price. The contingency funding, right over here, the first one, that's a pretty simple calculation, and that's equal to 1 month's average operating expenses for the first year. And I'm going to show you how that's computed in a second. The second one's a little more complicated, and that's the working capital. And just imagine a spreadsheet with 24 months, and there's a bunch of pluses and minuses going into that calculation. And these pluses and minuses are basically changes in your working capital, changes in your debt, and your equipment purchases. And this amount goes up and down each month. But I'm going to give you a real simple example so you can understand this working capital, because it's a pretty complex calculation. Just imagine in 1 month, actually the first month, you have pre-opening expenses of $1,000. And your patient receivables increase by $1,000 because they pay you in the next month, and your accounts payable decrease by $1,000, and you buy equipment for $1,000. That results in negative working capital of $4,000, which is referred to as your cumulative cash need. So for illustrative purposes, the example that I just gave you is only for 1 month, because this number really comes from 24 months of calculations. So over here we see the Schedule 1, and it's the, you can see we have the pre-opening costs here, and you can see over here these are the key numbers. Purchase price if you're acquiring a existing healthcare facility, working capital, which includes the pre-opening costs, and contingency funding. And what I did over here is these are the instructions that are on the bottom of the form. But over here on the bottom here, it talks about if your contingency funding was only, say, $100,000 on line 17, it says that the total proof of funding must exceed 3 times the number on line 17, which in our case would be 3 times 100,000 or $300,000. So if you just had one number here, these was 0, this was 100,000, then you'd have to have at least $300,000 in funds available. That's something that's often overlooked, but it's right there on the form. Over here, this is your Schedule 6, and this is called the source of contingency funding calculation, or basically it helps compute it, and it's really a P&L. And you can see we have the 12 months that are coming through, and you could see over here that you would just take the total here and divide line 35 by 12, and you would get the number for contingency funding. The source of working capital calculation on Schedule 1 is really coming from your cash flow statement, and it's really consists of your operating income from Schedule 6, which is your net income, which is right here on line 1. And then these are the changes that I referred to before, as well as your pre-opening costs. And here's the key number, the cumulative cash need. So if this cumulative cash need is negative, because you have negative working capital, then that number would go into Schedule 1. I hope you found this video helpful. If you have any questions, feel free to contact me at either my phone or by email. And finally, if you found this video helpful and want to hear from me again, be sure to subscribe and press the like buttons before you go.